Bismillahirrahmanirrahim. In the previous video, we talked about the fraud motivation triangle that consists of perceived pressure, perceived opportunity, and rationalization, which increases the likelihood of fraud when combined. In this video, we will talk about eliminating opportunities for dishonest acts, which is the second major element of fraud prevention. We will discuss five methods in this regard. Number one is implementing good internal controls, discouraging collusion, and informing external contacts about anti fraud policies, monitoring employees and establishing a hotline for anonymous tips, creating an expectation of punishment, and finally, conducting proactive auditing. These methods reduce opportunities for fraud, complementing the culture factors discussed earlier to form a comprehensive fraud program. Then we will also talk about how to create an effective organization to minimize fraud. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with having a good system of internal controls. Fraud occurs when perceived pressure, opportunity, and rationalization intersect. Eliminating any of these elements reduces the likelihood of fraud. To deter fraud, organizations rely heavily on effective control systems. The key components of an internal control framework include control environment, robust accounting system, effective control activities, monitoring and communicating within the organization. The control environment is shaped by management's conduct, communication, and principles. It sets the tone for employees' understanding of controls and forms the basis of other internal control elements. Key factors for a positive control environment include employee integrity, ethics, competence, etc. A robust accounting system that ensures accurate and timely financial reporting, then implementing policies and practices that safeguard assets and prevent fraud, and finally, regularly assessing the effectiveness of controls and communicating control procedures to the organization employees. Marjorie, the head of accounting at a small bank, embezzled 3.2 million over a period of 7 years due to various control overrides. Deposits and transfers were made directly through proof bypassing tellers. Marjorie kept a locked cabinet with restricted access to documents. Employees were instructed not to communicate with auditors, directing all inquiries to Marjorie. Vacation policies were adjusted for Marjorie, allowing her to take single days off and retaining control over her duties. General ledger tickets were pre signed by employees, bypassing approval requirements. Opening and closing procedures lacked oversight, with many employees having unrestricted access. Internal audit reports were not issued for 2 years and critical control tests were not performed. Incoming and outgoing cash letters were not consistently microfilmed, allowing Marjorie to manipulate them. Marjorie's accounts were not reviewed despite suspicious activities. Marjorie received a significant mortgage loan without proper evaluation. Employees handled their own bank statements, violating protocol. Managers failed to review key daily reports, overlooking significant fluctuations and overdrafts in Marjorie's accounts. These control breaches enabled Marjorie extensive embezzlement. This case illustrates how lack of adherence to control procedures can lead to significant fraud. Thus, a robust system of internal controls is crucial for preventing and detecting fraud. However, controls alone cannot guarantee fraud prevention and should be part of a comprehensive fraud prevention plan. By implementing and monitoring internal controls effectively, organizations can mitigate the risk of fraud and safeguard their assets and reputation. Next, let us talk about discouraging collusion between employees and others and alerting vendors and contractors to company policies. About 71% of the frauds are perpetrated by individuals working alone, while the remaining 29% involve collusion and are harder to detect. Collusive frauds takes time to develop as it requires building trust among participants before committing the fraudulent acts. Two factors or two recent trends in business have likely led to more collusive frauds. Firstly, the increasing complexity of business environment means trusted employees often work in isolated or specialized settings, making collusion easier. Trusted individuals are often the ones committing fraud, leading to disbelief and shock when their actions are revealed. Secondly, the rise of supplier alliances, which rely on oral agreements and closer relationships, can obscure paper trails and facilitate collusion. Trusting people too much, especially in situations like supplier alliances, increases opportunity and temptation for fraud. An analogy illustrates this point. A company hiring wagon drivers asks candidates how close they should go to the edge of a cliff without falling. The first said second 6 inches, the second said 3 inches, but the third one wisely said he would keep the wagon as far away from the edge as possible to avoid risk. Fraud is akin to navigating a perilous road. When risks are high, problems are more likely to arise. Employees tasked with securing contracts with vendors alone can succumb to bribes and kickbacks, especially when the potential gains are significant. Purchase and sales frauds are common in collusive schemes, where even those bound by professional codes may yield to temptation. Consider the ESM fraud case, where a CPA partner accepted a bribe of $150,000 to ignore fraudulent transactions exceeding $300 million. His continued engagement enabled his involvement in the fraud and damaged his integrity. Innocent vendors and customers may get involved in fraud because they fear losing their business relationships with the organization if they refuse to participate. In many cases, these customers or vendors only interact with the firm a few times. They might feel pressured or intimidated by the person asking for illegal favors or inappropriate actions. Regularly sending out letters outlining the organization's anti fraud policy to vendors can clarify expectations and deter fraudulent behavior. In some cases, vendors expressing concerns about their relationships after receiving such letters have uncovered instances of fraud. For example, a major fast food chain uncovered a 200,000 kickback fraud from the suppliers. Following an investigation, the chain sent letters to vendors stating its policy against accepting gratuities. This led to the discovery of two additional fraud cases involving buyers. Another effective precaution is adding a right to audit clause on purchase invoices. This informs vendors that the company can audit their records anytime. It deters improper payments because vendors know their records might be checked, which help during fraud investigations. In summary, addressing collusive fraud requires proactive communication of company policies to vendors and contractors, as well as implementing measures to deter improper payment and enhance oversight. These steps are crucial in maintaining integrity and preventing financial losses due to fraud. Next, let us talk about monitoring employees and implementing a whistleblowing system. Fraudsters typically spend stolen money conspicuously on luxury items like cars, homes, vacations, and extravagant gifts. Close observations by colleagues can detect fraud early and deter potential perpetrators. The Sarbanes-Oxley Act mandates whistleblower systems in public companies to facilitate reporting of suspicious activities. Many frauds are uncovered through tips from employees or customers rather than audits. Challenges include fear of retribution, poor organization culture, unclear policies, and lack of awareness. Solutions involve ensuring anonymity, independence, accessibility, and prompt follow up of reported incidents. Whistleblowing systems are not exclusive to the United States. Major countries, government agencies, and foreign companies also implement them. For example, Toshiba introduced a risk hotline for employees to report concerns and seek advice with enhanced features like direct links to outside attorneys. Overall, effective monitoring and whistleblowing systems play critical roles in detecting and preventing fraud, fostering transparency, and protecting employees who report misconduct. Next, let us talk about creating an expectation of punishment. Fear of punishment serves as a significant deterrent to dishonesty. Mere termination from a job is often insufficient as meaningful punishment. Real punishment involves embarrassment and accountability to family and friends. A well publicized prosecution policy communicates that dishonest acts will face harsh consequences. It sends a clear message that unauthorized actions like borrowing from the company will not be tolerated. Failure to prosecute can imply tolerance to fraud and weaken deterrence. Termination alone is not a strong deterrent due to privacy laws and high job turnover rates. Similar to a code of ethics, a robust punishment system helps eliminate rationalizations for fraudulent behavior. Insurance fraud is a significant problem, costing insurers billions annually. Lack of prosecution for white collar crimes like insurance fraud can embolden others to pursue criminal activities. The focus on prosecuting violent crimes has led to a rise in white collar crime, with fraud going largely unpunished, thus creating an expectation of punishment through a strong prosecution policies is essential for deterring fraudulent behavior. Failure to prosecute sends a message of tolerance and can contribute to the proliferation of fraud in society. Next, let us talk about conducting proactive fraud auditing. Many organizations do not actively audit for fraud. Auditors typically focus on financial, operational, and compliance audits, investigating fraud only when symptoms are severe. Proactive auditing for a fraud raises awareness among employees that their actions are subject to review, reducing fraudulent behavior by increasing the fear of detection. The steps of good fraud auditing are identifying fraud risk exposure, that is, recognizing areas vulnerable to fraud, identifying fraud symptoms, understanding that means understanding indicators of fraudulent activity, building audit programs, that is, developing strategies to proactively detect symptoms and exposures, and finally, investigating fraud systems, that is, taking actions upon identifying potential fraud indicators. A company can use proactive computer auditing to compare employees' telephone numbers with vendors' numbers, revealing instances of employees purchasing goods and services, that is, a conflict of interest. CPA firms, motivated by SAS number 99, actively consider fraud risk during financial statement audits, emphasizing increased skepticism and unpredictable audit test. SAS number 99 aims to enhance auditors' ability to detect fraud by requiring explicit considerations and brainstorming about fraud risk. Large CPA firms have special teams focused on finding fraud before it grows. They use technology to spot fraud better. This proactive approach doesn't just catch fraud sooner, it also stops it because employees know the company is watching for fraud. Proactive fraud auditing is crucial for deterring fraudulent behavior by creating a fear of detection and consequences. By minimizing fraud opportunities, it becomes more challenging for individuals to justify engaging in fraudulent activities, requiring increased pressure and rationalization to do so. In essence, proactive fraud auditing complements internal controls, discourages collusion, promotes employee monitoring, and establishes an expectation of punishment, making it a vital aspect of fraud prevention efforts. Thus, it can be summarized that preventing fraud uh, can be done by creating a culture of honesty, by promoting openness, assistance, and integrity within the organization, helping in preventing fraud by fostering an environment of transparency, eliminating fraud opportunities, essential for reducing fraud instances. This includes implementing robust internal controls and discouraging collusions. If organizations employ these strategies, they can significantly reduce fraud problems. Finally, let us talk about organizations and fraud, the current model. Now, many organizations lack a proactive approach to fraud prevention, leading to confusion about responsibility. The current model follows four steps. First is the incident occurrence. Fraud incidents happen without prior prevention measures. Organizations enter crisis mode seeking to identify perpetrators and mitigate impacts. Security and internal audit get involved. Investigations entail interviews, document scrutiny, and can be time consuming and costly. Company decide on actions against perpetrators, no action, termination, or persecution. Closure, that is, loose ends are tied, employees may be replaced, and new controls may be implemented. Often, no further action is taken until another fraud occurs. So, a better approach to fight fraud is setting a positive tone at the top. That is, the management should set an example of integrity and promote fraud education and a corporate code of conduct. Changing attitudes towards prosecution significantly reduces fraud instances. Then, educating employees about fraud seriousness and reporting procedures is crucial for prevention. Fraud awareness training helps limit financial exposure and negative impacts on the work environment. Then, integrity risk assessment and internal control, that is, analyzing fraud occurrences, helps understand preventive measures needed. Implementing effective control reduces future fraud risk. Then, reporting and monitoring facilitate fraud reporting through hotlines and effective monitoring system. Employees and vendors aware of monitoring are less likely to commit fraud. Then implement proactive detection methods to detect fraud early. Awareness of detection methods acts as a deterrent. And then finally, effective investigation and follow up. Establish a formal fraud policies and investigation procedures. Prosecution policies should deter future frauds and have top management support. So, the amount of fraud in organizations depends upon training, tone at the top, risk assessment, controls, detection programs, and investigation procedures. So, this completes the second video on preventing fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.